Most of you are familiar with CUNA, trade association for credit unions, so I'm going to skip over kind of that junk. But I want to talk about our advocacy goal. Our goal for 2018 with the current Congress has been to make the environment for credit unions as positive as possible to allow for growth, to allow for you guys to be able to serve your members effectively. That includes removing regulatory barriers. You might traditionally hear this as regulatory burden, as well as expanding credit union powers and opportunities. And we do that through a couple of different ways. Our focus in advocacy, our strategy, is to think about everything in a 360-degree approach. And what that means is, there's not just regulatory issues and legislative issues. Really, every single thing that we deal with, we approach from what can we do on the legislative side of things, what can we do on the regulatory side, political, do we need to get the state leagues involved, so on. So we want to make sure that we're approaching every issue from every angle so that we can be effective as an organization. Our agenda today is pretty straightforward. I'm going to talk to you guys a little bit about the upcoming election, as well as legislative developments, S21, 55, our big reg relief bill that was passed earlier this year, and then finally an update on NCUA, BCFP or the CFPB, whichever you like to use nowadays, as well as just a few other agencies that are particularly pertinent to credit unions at the moment. So the election. So like I said, we're about 35-ish days away from the next election in November. One thing fact that I found that I thought was particularly noteworthy was that in every midterm election since the Civil War, the president's party has lost, on average, 32 seats in the House and 2 in the Senate. I think that's particularly noteworthy because if you look at the other part of the slide, Democrats need 23 seats in the House in order to gain the majority. They need 2 seats in the Senate. Conventional wisdom has largely been that the Democrats are going to be taking the House and not the Senate. The way that the electoral map works for the Democrats is not particularly beneficial. They would have to kind of run the board in a lot of traditionally red voting states, such as Texas and so on, although there is a competitive race down there. After the election, regardless of what the power dynamics are going to be going forward, what we're likely to see is kind of the last few things that this Congress wants to get off their plate getting pushed through. That would include the nomination of Kathy Kraninger, potentially the NCUA board nominees being approved, as well as maybe some sort of really technical fix bill to the tax bill. We call it Tax 2.0. I think they might even be on 3.0 at this point. But those are the kind of things that you're going to see in this lame duck Congress. Given that the traditional wisdom is that the Democrats are going to take the House, what we'll probably see in the next Congress is a lot more kind of liberal-focused bills that would ostensibly protect consumers to a greater extent. Maxine Waters is going to be the head of House Financial Services, most likely. She wants to focus on GSE reform. There are some bills that would limit overdraft outstanding, and so on. But again, if so long as the Republicans maintain their power hold on the Senate, and then with President Trump still in office, maybe not, who knows, we'll still have that firewall for any bills that would be particularly harmful for credit unions. So to talk about recent legislative developments, I just want to spend a few minutes on S2155, our big regulatory reform bill. This was something that is particularly noteworthy because it was the largest regulatory reform effort since Dodd-Frank was passed 10 years ago. And it included a number of provisions that were beneficial to credit unions. This was a large compromise bill. Community banks got some things from it, credit unions as well. And the reason why it wasn't a little bit more beneficial, providing field of membership relief or an RBC delay or something like that, is because it was carefully compromised in the Senate. It required 60 votes, so bipartisan effort in the Senate in order to pass. And so it was carefully negotiated, and there really wasn't room for adding in anything else. There was some worry that if you started adding in a few other piecemeal pieces of legislation, the whole entire thing was going to fall apart. Most of the regulatory relief for credit unions related to the CFPB in this area, but there were a few things on the NCUA side. We'll talk about that. Specifically, providing parity with banks on 1 to 4 non-occupied owner loans, as well as HMDA reporting changes for small institutions, creating kind of an exemption threshold, as well as providing relief for QM loans that are held in portfolio, and so on. It's kind of like a grab bag of different issues that were helpful to credit unions. Nothing dramatic, but we're taking a step in the right direction with this bill. On the regulatory side of things, a lot of regulators are now focused on implementing the relief that was passed by Congress. I'll talk in a second about what the CFPB is doing, and NCUA as well. So BCFP, actually, quick question. How many of you guys know what the actual controversy is between BCFP, CFPB? Raise your hand. One person? All right, I think this is a very DC thing, so I'll tell you guys a story. So when the Dodd-Frank Act was passed, in the act it says Bureau of Consumer Financial Protection. That is the name of the agency. But when Director Cordray was in charge, he decided that consumers needed to come first. So in all of the marketing and messaging and on the website, they changed the name. Again, that's what Bureau of Consumer Financial Protection is, a name in Dodd-Frank. They changed the name to Consumer Financial Protection Bureau, and that's how they marketed it. And 5 years later, that became really the name of the agency for all intents and purposes. That's what people referred to it as. When Acting Director Mulvaney was appointed and took over, he decided to, one, read the actual text of Dodd-Frank, and he realized Consumer Financial Protection Bureau doesn't exist. It's the BCFP, it's the Bureau of Consumer Financial Protection. And so what he felt was that if you're willing to kind of fudge the legal reasoning on the name, then that creates a culture within the agency to not really follow the law on everything else, from their rulemaking to their guidance to their examinations and so on. And so he thought that if you start at the top, literal top, say in the name, BCFP, it would create culture change within the agency. And that's something that he's been focused on a lot. So that's kind of the origin of that little controversy, CFPB versus BCFB. We saw after Director Cordray resigned, there was this leadership turmoil. There was a day after Thanksgiving where we literally had two people claiming to be the acting director. We had Mulvaney appointed by the president. We had Leandra English, who allegedly was promoted to the job upon Cordray's resignation. They showed up on a Monday. At the time, the Bureau had two offices, one around Capitol Hill, another in northern DC, and they alleged to be the acting director, and they were sending emails as such. So it was a very confusing day for staff and for us on the CUNA side as well, trying to find out who is actually in charge of this major, powerful agency. Throughout the day, there were multiple different developments. Eventually, the CFPB or BCFP's general counsel weighed in and said, Acting Director Mulvaney is the acting director of the Bureau, and ignore all communications from Leandra English in that capacity. And so that kind of settled things a little bit, but Leandra English decided to sue. She was sued for her job. There's the case English versus Trump, and the argument was that the Dodd-Frank Act basically allowed for the individual who was the deputy director of the Bureau to get elevated to acting director upon resignation of Cordray. However, there's another federal law called the Federal Vacancies Act that allows the president to assign someone to be the acting director of a regulatory body for a period of 210 days. And so President Trump did that, and then there was this kind of debate about which one is actually effective, which one came first, which one came later in time, and so on. Eventually, that case was dropped. In fact, it was heard by Justice or Judge Brett Kavanaugh when he was on the DC Circuit. So he weighed in on that issue. But Leandra English dropped her claim. She ended up leaving the lawsuit, and now we have Acting Director Mulvaney. He is the unquestioned leader of the Bureau. Let's talk a little bit about the nominee that we have kind of in consideration right now, Kathy Kraninger. She is currently a manager at the Office of Management and Budget. She's one of Acting Director Mulvaney's, or director in his OMB capacity, Director Mulvaney's chief lieutenants over at OMB. She has a lot of governmental experience, and the reason why she was nominated, she was a little bit of a surprise pick for a lot of people, and she doesn't have any financial services experience. She's not really familiar with banks or credit unions, but why would they bring her in? And the reason why is because the administration really felt that the largest issues with the Bureau was that it was mismanaged, budget-wise, culture-wise, and so on. And so they wanted to bring in someone who had a lot of governmental management experience to really lead the Bureau into the future, to change the kind of culture of the agency. She had a confirmation hearing. As you can expect, she got grilled on her lack of financial services experience, but she very much hinged on, I am able to manage budgets, people, and determine how resources can be used efficiently. And so that was her kind of basically making her case to be the next director. We expected a vote to move fast on this. There was supposed to be a vote in early August to determine whether or not she was going to leave committee and then be, on the floor. That's been delayed, and so we're still waiting to find out what's going to happen with her. One thing that's particularly noteworthy about her nomination is the way that Federal Vacancies Act works is you can only assign someone to be acting director for a temporary period of time, and it's basically like a 210-day clock. But once someone gets nominated, that clock resets. And so when they brought it down almost to the wire, I think Kathy was nominated on like the 208th day of Mulvaney as acting director, but that reset his clock so that he had another 210 days. I think this 210 days ends sometime around mid-February. Hypothetically, if her nomination falls through, then the president can nominate another person, and that would reset the clock again. So he'd get Acting Director Mulvaney, and potentially could be the leader of the Bureau for the foreseeable future for the next few months. So what has the Bureau been like under Acting Director Mulvaney? It's been really night and day difference from how it was under Director Cordray. Mulvaney was quick to initiate a number of changes, a hiring freeze that, although it's been lifted, really practically is still in effect. They haven't added many career staffers. They've brought in a number of political appointees, but they've tried to get the agency size smaller over the last year. They halted new enforcement cases and issued a pending review of all of their enforcement actions, all of their rulemakings, and so on, to make sure that they're, again, abiding by their statutory authority. And then also just new leadership in the Bureau. So they have a new chief of staff. When Leandra English officially resigned and dropped her case to be acting director, Brian Johnson was named the acting deputy director of the Bureau. He's somebody who worked for House Financial Services Chairman Jeb Hensarling. He is somebody who's very interested in making sure that regulation has proper cost benefits analysis, ensures that there's not overly regulatory burden is minimized, and then there's statutory authority to actually do whatever the Bureau is attempting to do. One thing that I want to note while I'm on a slide that mentions political appointees is, there is a budding controversy right now at the Bureau that, could potentially have substantial changes to leadership. While the rest of the nation is focused mostly on, what's happening with the Brett Kavanaugh nomination, on the CFPB side, one of the political appointees that was brought in by Acting Director Mulvaney, his name is Eric Blankenstein. He's in charge of enforcement, supervision, and fair lending. Recently, and by recently I mean just last week, a few writings from 2004 resurfaced that have some racially insensitive comments in it. As a result, there's kind of a question and really an outright rebellion within the Bureau right now to try to get him removed. A few of the directors of enforcement and fair lending have weighed in on this and alleged to have the support of over 100 CFPB attorneys trying to get him to either resign or be fired from his post. At this point, it's still uncertain what's going to happen, but I think that we could likely see some more leadership change and resignations over at the Bureau. So it's fairly controversial, and it's still kind of a story that's unfolding. As far as what Acting Director Mulvaney has kind of been focusing on structurally, like how does he want the Bureau to be formed going forward? Just like when he was in Congress, he wanted, this regulator, which is, it's not hyperbole to say that it's the most powerful regulator in Washington, D.C. The director of the Bureau is not fireable by the president. They have, the ability to essentially go to the Federal Reserve and get an unlimited amount of money from them at any period of time. They are basically unanswered. They don't answer to anyone, whether it's Congress or the president or so on. And so he thinks that the path forward is to make structural change at the Bureau. Obviously, that needs to be on the legislative side of things, but it's helpful when the acting director and whoever ultimately becomes the permanent director are calling for the CFPB to be under congressional appropriations, to have CFPB rules evaluated by Congress and basically get legislative approval. And then for CUNA and for our part, we really think that this single director structure is not workable. There needs to be a multi-member commission that heads the Bureau in order to provide stability. We're agnostic to whether that's 3 people or 5 like the NCUA or 5 people like some other boards within government, but we think that there needs to be one person. There can't be these big shifts anymore between one director to the next director. One thing that acting director points out is that if you don't like what he's doing with the agency, make it a commission, because then he'd have a lot less ability to just completely change how the Bureau approaches what they do on a day-to-day basis. From a kind of culture perspective, what he wants to focus on is no longer what he called pushing the envelope. Director Cordray had instilled kind of this vision of the agency as constantly searching for the frontiers of their regulatory authority. And they were willing to go to court in order to kind of enforce that, whether it was their interpretations of fair lending laws or TILA or any of the others, overdraft, UDAP, so on. They wanted to try to push the boundaries of what they could do, and occasionally they got slapped down by the courts, but they thought that it was their job to basically be overzealous when it comes to their statutory authority. Mulvaney is the exact opposite. He wants to read the statute and truly understand it and find out what exactly can they do and can't they do. And I think one kind of situation that's that's an example of this is Military Lending Act examinations. So the Bureau is considering a policy at the moment. They haven't officially announced that it's going to roll out, that they're going to end examination activities related to the Military Lending Act. And the reason why is because in the statute, Dodd-Frank allows the Bureau to examine for the provisions of Dodd-Frank and 18 different enumerated laws. And Military Lending Act is not one of those laws. And so they think that there's a case that they don't have the authority to examine for the MLA. That's questionable and obviously a double-edged sword. We want a fair playing field. It would be concerning for us to have, some lenders or some types of institutions not examined for the MLA while NCUA has the Military Lending Act on its supervisory priorities. We think that that's unfair. But to his credit, Acting Director Mulvaney has also at the same time called for Congress to provide him with that authority. This is an oversight, this is an error, most likely, and Congress needs to respond and allow the Bureau to actually do these activities. They're not going to completely step out of the MLA space. They still would look at complaints to the Consumer Complaint Database, and other kind of sources of information, but they just wouldn't be doing proactive examinations of the MLA with their supervised institutions. In addition, they want to change the practice of, regulation by enforcement. This was especially noteworthy with UDAP, unfair, deceptive, and abusive acts and practices. Director Cordray didn't want to come out with a rulemaking on this and preferred instead to have enforce this through consent orders. Basically, have a specified set of facts and circumstances that an institution had done, have them, sign a consent order, not necessarily admitting to those facts, but, saying that, this potentially could be a violation of UDAP and then pay a fine. And the problem with that is that, the institutions who are outside of that decision making, they have to rely on the facts, which are sometimes very specific, in a consent order while not having a rule to follow. Mulvaney wants to end that. He doesn't want to do that anymore. He wants you guys to have clear rules of the road to know what you can do and what you can't do. So that's something that's a positive change over at the Bureau. And then finally, enforcement needs to be based on quantifiable and unavoidable harm. He doesn't want the Bureau to be just kind of searching for UDAP and kind of, again, pushing their authority to the furthest that it possibly can be. He thinks that it needs to change and things need to be a little bit more quantifiable. One of the big initiatives that Mulvaney undertook in his first year was the request for information, RFI process. What they did is they issued 12 RFIs on every aspect of the Bureau's operations, from how they do rulemaking to how they issue guidance, examination activities, the various rules in which they have under their authority, and so on. And their goal there was to find out how the Bureau can be better at what they do. Where are the pain points for financial institutions and other actors, and how can they change those for the better? One thing that the Bureau never really had was kind of self-reflection on how they can be more effective. They can ensure that they're enforcing the law, that credit unions and other financial institutions within their scope of authority feel that the rules are clear and so on. And so Mulvaney kind of undertook this process. And we've already seen a number of changes as a result. Their next step on this is likely going to be coming out with a report on the RFI process that's going to basically provide a guideline for whoever ultimately takes over at the Bureau on how they can change the agency for the better. I want to talk really briefly about a few upcoming major rulemakings. We'll start with payday. So the payday rule came out a while ago. It came out pretty good for credit unions. It provided an exemption for NCUA's Pal Loan program. It kind of focused on the types of actors that we expect the Bureau to focus on, predatory payday lenders. Since then, there's been a pretty loud call from various sectors of the industry, that specifically payday lenders, that the rule should be completely rescinded, that the Bureau needs to completely erase this rulemaking. We at CUNA have been skeptical and objected to that complete rescission, and the reason why is because these are the type of actors that need to be regulated. Predatory payday lenders have done a lot of damage in communities, and this is the type of rulemaking that the Bureau needs to have in place. What we do think that they should do is revise some of the rulemaking in order to allow for more credit unions to service short-term small dollar lending need in their communities. So widening that exemption for credit unions has been our priority. They still they haven't officially come out with any proposal on this, but I think they're probably going to come out with one in early 2019. HMDA, there was some relief in the 2155 reg relief bill. The CFPB just issued a few weeks ago an interpretive rule implementing that regulatory relief, providing a wider exemption for financial institutions from reporting HMDA data. It's still important that institutions report their HMDA data, but some are allowed to basically report a smaller data set than they would have been required to do had the bill not passed. In addition to that, they're focused on trying to find other areas that they can provide relief for institutions. That could include decreasing the total data set officially. That could also include potentially raising a number of the thresholds within HMDA to exempt more financial institutions. HMDA has been one of those rules that Acting Director Mulvaney really feels like the Bureau overstepped their bounds, and so he wants to bring them back in order to make sure that they're getting effective data, but they're not overburdening smaller lenders and therefore decreasing the amount of credit that's available to borrowers. Debt collection is a rulemaking that was started under Cordray, but Acting Director Mulvaney has basically outright said that they intend on pursuing this. It's not going to die. It's not going to go to the wayside. In fact, it's a key priority for them. And the reason why is because Acting Director Mulvaney, when he was kind of evaluating the space, the consumer complaints, and so on, he found that consumer complaints weren't about payday lending or overdraft or other types of things that Director Cordray had focused on. Instead, the vast majority of complaints were about debt collection. So he wants to undergo a rulemaking that focuses on third-party debt collectors, so not first-party debt collectors, and mostly focusing on how consumers are treated, and then also verifying debts, verifying the individual and their contact information, and so on. And now there could be trickle effects that reach credit unions and other depositories based off of the requirements that third-party debt collectors have to undergo. But at this point, the Bureau really wants to have a minimal impact on traditional depository institutions. They're still under the working stages on this. I think that a rulemaking or a proposed rule is probably unlikely to come out anytime before mid-2019, but it's definitely on their agenda and they're dedicating resources to come out with a rule on this. Prepaid accounts. On this rule, they kind of kicked the can down the road a little bit. They extended the implementation date into April 1st, 2019, but they're undergoing a review of the rule to try to find if there are any areas that they need to provide clarity in, areas where Cordray kind of overstepped his bounds, and with a plan to kind of reel it in a little bit. They have a lot on their plate right now, and I think that the prepays rule is likely their lowest priority when it comes to these major rulemakings, but it's still something that they're evaluating to try to find out how they can change it to make it better. One of the themes you're going to kind of see from what I've been telling you about the Bureau is they want to do things differently. It's definitely a different Bureau than we interacted with just a year and a half ago. They're more receptive to feedback from stakeholders. They want to know exactly what the pain points are so that they can ensure that these rules are protecting consumers while not stifling opportunities for those same consumers. And so there's a lot of positive things there. A few longer term projects over at the Bureau, the small business lending data collection. That's something that is required of them in Dodd-Frank. It's called Section 1071. They have to come out with a rule on this, but Dodd-Frank didn't specify any time period, which is why it's still outstanding all these years later. When Director Cordray was in charge, there was a kind of sentiment over at the Bureau that this was going to be HMDA on steroids. I think I literally heard one of the Bureau attorneys call it that. And so obviously there was a big concern about creating a second HMDA. That's done. What they want to focus on is trying to get a picture of the market, what small business lending looks like, but not create the same type of regulatory burden as you see on the HMDA side of things. They're still a little bit uncertain of what they want to do in this area. Specifically, how do you define a small business? Is it, the business is small? Is it the loan is small? Is it, the number of employees, the amount of revenue, so on? There are a number of different ways that they could try to define a small business and they collect data about it. And they just plain don't know what they want to do in this area yet. So this is why this is a longer term project. If I had to guess, it says unlikely to propose a rule in 2018. They are not going to propose a rule in 2018. This is more likely a late 2019, maybe even more likely than that, early 2010 project. That's when I would expect a proposal to come out from them. Another thing that's required of the Bureau are they're called Dodd-Frank 5-year lookbacks. So they have to review each of their major rules, remittances, ability to repay, and so on, to really see how did the rule, when the rule met the road, what was the effect? Did it have the intended and desired outcomes? And I think that if you had Director Cordray still in charge, you probably would have got reports that, and these have to be issued to Congress, you probably would have got reports that said remittances rule is great, it did everything that we wanted it to do, it's awesome, no changes needed. But now that you have different leadership structure in place, I think Congress is really going to be looking at these reports to have a little bit more honesty. Remittances, for example, it had a pretty negative effect on the industry at large. A lot of credit unions and other depository institutions completely pulled out of this space because it wasn't worth it anymore. They had traditionally done it as a member service. And I think what you're going to see is this report say that, which was something that was unlikely to happen, if not for Acting Director Mulvaney taking place. But we expect these reports to come out at some point towards the end of the year, and I think they're going to be used to really try to find out how the Bureau wants to change those types of rules into the future. Overdraft, I'm happy to tell you guys that overdraft at the Bureau is dead. It's off their regulatory agenda. They will not be coming out with a rulemaking on it. They very much see this as an area where consumers like it, they like overdraft protection, they want it, and they don't want to limit people's access to it. In previous years, it was always on the rulemaking agenda. We always thought Cordray was going to ultimately come out with something. Acting Director Mulvaney and likely any other future director of the Bureau has said no, that's not what they do. But there are still concerns out there when it comes to overdraft. Senator Booker, just a few weeks ago, proposed a bill that was going to substantially limit overdraft. In fact, nearly ban it. It was going to require a number of other additional requirements on top of the ones that are already in effect, and would essentially kill the product. Again, that's not a huge concern. No, it's something that we have to stay vigilant on because we don't know what's going to happen with Congress going forward. If you have a House and a Senate that are both controlled by Democrats, then there's potential for that type of bill to get traction. At this point, it's mostly just something that people are going to be campaigning on, which is the reason why it was released. But that's kind of the latest with overdraft. Before I move on to NCUA, are there any questions on the Bureau? Anything that I could address? Yes, sir.
We heard that the examinations of really large credit unions headed by the BFCP have been needlessly long and adversarial. Has that changed with the change in leadership?
The question was about whether the examinations, which for credit unions over $10 billion, were needlessly long, and whether or not there's been a change at the Bureau. And there has. There absolutely has. The Bureau has tried to make their examinations more efficient, and that means less time in the actual institutions, as well as limiting the scope, not trying to do fishing expeditions. In the past, there have literally been circumstances where the Bureau does their initial examination and they don't find any violations of consumer protection law, and leadership said, no, go look again. That's how we ultimately resulted in the first consent order on a credit union that we got. So there is a different approach for all lenders, not just credit unions, but there's definitely been a pullback to what they are required to do as opposed to trying to find as much. Any other questions? All right, we'll talk a little bit about NCUA. I'll start with board composition. Chairman McWaters has been, chairman for almost a year at this point, or over a year. Basically, he has pursued an agenda that has been very beneficial to credit unions. There was some concern when he was initially elevated on, we only have 2 board members, 1 Democrat, 1 Republican. Is it going to be gridlock? Are they going to find areas where they can compromise, or so on? And it's proven to be the case that they have found areas that they can compromise. We've gotten, some measured regulatory relief out of NCUA over the last year. There's still the empty seat that was left vacant when Chairman Matz left, quite a bit ago, over 2 years ago. Nobody was ever nominated for that role. But we recently saw a nominee for the Metzger seat. That was Rodney Hood, who previously served on the NCUA board. He's a Republican, somebody who's been in the past very supportive of credit union regulatory relief. He's been at JP Morgan Chase for some time since leaving the NCUA board. We've gotten the kind of message from Senate Democrats and Republicans that the Rodney Hood nomination is not going to move until there is a Democrat nominated as well, so that they can move them as a pair, as opposed to having just 2 Republicans on the NCUA board. And that person hasn't been nominated yet. There are a couple names on the kind of short list at this point, and are going through FBI vetting, but we don't know when those are actually going to come out. It could be in the matter of a few weeks. I think most likely after the election, because they want to try to move those fast, in that lame duck period. Board member Metzger has been staying on beyond his term. The Federal Credit Union Act allows for a board member to continue to serve on the NCUA board after their term expires until their successor is named and nominated. There was a little bit of concern that he would leave, which would make the NCUA board just 1 person, and that would basically a single person NCUA board would be unable to actually do anything. Luckily, he's stayed on for quite a bit of time, so that he's been able to get a few things done. But hypothetically, if he leaves and we don't have those 2 nominees confirmed, there's potential to be a little bit of a halt of business as usual over at the NCUA in the near future. Hopefully it doesn't happen, but we'll see. NCUA under McWaters, he's been focused on increasing the efficiency of the agency, while also what he calls a thoughtful loosening of regulatory burden. Some of his priorities have been closing the stabilization fund and issuing dividends, as well as streamlining the agency budget, finalizing a few regulatory relief rules, field of membership, RBC, stress testing, advertising, and a few others. Most of the relief has been very measured and kind of, in some cases, very technical. But that's because we have 1 Republican and 1 Democrat on the NCUA board. They have to find areas they can compromise. You're not going to get an overhaul of risk-based capital when you have Metzger on the board, who needs to vote yes for any rule to come out, and he has been very vocal about his support of the RBC rule. You're more likely going to see, these sort of substantial revisions, after we get another individual who's regulatory relief minded on the NCUA board who can work with Chairman McWaters. A few other things, extending the examination cycle for all credit unions has been a priority, as well as, just looking at how credit unions can provide greater assistance to their members. They created a new office over at NCUA called the Office of Cure. It's focused on credit union resources and expansion. So equity distributions, this is something that McWaters really saw as providing an opportunity for doing a couple things. Doing a dividend to credit unions, but also shoring up the stabilization fund, in anticipation of some issues that can come up, specifically taxi medallions, making sure that the share insurance fund had enough resources to weather those potential negative events without having to, get a premium for credit unions. So just a few months ago in July, they issued a dividend payment of $736 million to credit unions. So that's a positive thing. But during this process, they increased the normal operating level from 1.3 to 1.39. we at CUNA think that that should come down as soon as possible. It was something that provided a lot of backlash from the industry. It was seen as needlessly excessive, and so NCUA has indicated that they want to bring it down at some point in the future, but they want to do it in a very measured way. I think you're likely going to see that play out over the coming months and years. Another thing, again, focusing on efficiency, was restructuring. They want to consolidate some of the regions. They're going from 5 to 3, closing down the Albany, New York, and Atlanta, Georgia offices. If some of you have seen the map, it's essentially cutting the country into 3 slices. That western slice is a massive region, basically half of the country. So it remains to be seen how this is going to play out. But what they wanted to do was eliminate the amount of leases that they have, and also, through attrition, reduce the amount of staff. NCUA regulates the smallest number of credit unions it ever has. Meanwhile, they have the largest staff they had ever had and the largest budget they have ever had. So obviously there's a disconnect there. And McWaters sees that, which is why he thought closing the offices, negotiating with NCUA Employees Union in order to have a kind of a transition period where people can decide whether or not they want to relocate or leave the agency. And so that's playing out. Those 2 offices are officially going to be closed by next year, and that's when the new regional structure will be in place. In addition, there's a change to the Office of Examination and Insurance. Instead of focusing on kind of regional groups, they want to focus on specialized working groups to allow them to be more effective in addressing these issues that come up, like taxi medallions or so on. Another slide about the restructuring. Again, those 2 offices are expected to be closed at the beginning of next year. Field of membership, the litigation is still outstanding. As many of you remember, the American Bankers Association sued NCUA over their field of membership lawsuit, or over their field of membership rule. The district court was basically a split decision. They invalidated 2 of the provisions related to community charters, while they also upheld 2 of the provisions related to community charters. NCUA appealed. So the ABA cross-appealed. It's currently at the appellate level, and still hasn't been, and there hasn't been any hearings or progress on that so far. These things are very slow, especially in the DC circuit. So that's going to be something we're probably going to see play out over 2019. In the meantime, CUNA has been working with NAFCU and other interested stakeholders in the credit union industry in order to defend the field of membership rule. We really think that this is a rule that NCUA was well within its statutory priority to come out with, statutory authority to come out with, and so we think it's important for NAFCU and CUNA to stand together as representing the industry to defend this rule and ensure that credit unions are able to expand and provide service to more members. In the meantime, NCUA did issue what they call FOM2, another field of membership rule that provided some relief. One of the provisions that is particularly noteworthy is, they were considering raising a few of the thresholds within the field of membership rule. Based on the litigation, they decided not to do that. However, they provided a little bit of an out. They would allow for a credit union to enter a space with a population above the current threshold, 2.5 million, so long as they do so through the mechanism of a public hearing. Basically, you could provide a narrative instead of raw statistical mean methods. You can provide a narrative as why this is part of a well-defined local community, and that would be subject to a public hearing in which bankers could object, or the public, or so on. So it's a little bit more risky for a credit union to go through that mechanism, but at the very least it provides you with an option. One of the other things that they have on their plate related to field of membership is looking at, based off of how the litigation ultimately plays out, any additional relief they can provide. I know that NCUA has also been working with Congress to try to determine, hey, if there could be potential for structural changes to field of membership, through changes to the Federal Credit Union Act, is that something that could be a possibility? And again, it remains to be seen, and it'll depend on, what party control we have, after the election next month. The voluntary mergers rule, there was a little bit of concern about whether or not, when there was a voluntary merger, if compensation was tied to that, was that transparent enough for members? Sorry, check my time. Was that transparent enough for members? They're not trying to, and by they I mean NCUA. NCUA is not trying to prevent credit unions from merging. Instead, they just want to make sure that members have as much information as possible. They're kind of agnostic to the amount of compensation that's tied to a merger, but they want the members to know about it when they're voting on it. So that's what they tried to do in this rulemaking. It wasn't as bad as we expected, although both CUNA and other trade associations objected to kind of the need for this type of rulemaking. NCUA already had the authority to put a hold on any merger that was going through based off of various concerns that they could have with it. And so it didn't really seem to need to be a rule, but they issued it and it's been effective for October 1st, so it's been effective for 1 day. Payday alternative loans is a proposal that came out from NCUA. What they want to do is allow for, like I mentioned with the CFPB angle here, they want to allow for credit unions to service these types of individuals who are looking for short-term small dollar lending options. The PAL loan program never really got as much traction as they had hoped. I think only 12% of credit unions provided some type of PAL loan program. They want to try to get that number a lot higher. And so they're calling it PAL 2. It would allow for an increased amount of loan amount. It would allow for an individual to come into the credit union and be eligible for a PAL loan that day. One of the big problems with the current PAL loan program was that it requires a 30-day waiting period. Basically, an individual has to be a member of the credit union for 30 days before they're eligible for a PAL loan. And if you're familiar with the types of individuals who are in need of emergency credit, generally they can't wait 30 days. So NCUA saw this as a problem and they wanted to get rid of it. This would still, PAL 1 would still exist at the same time as PAL 2. And they're also looking at the potential of a third option, PAL 3. We think that this is a good step in the right direction. They should provide more flexibility to provide short-term small dollar lending to communities, but they need to do more than this. They really need to make these types of products, at the very least, minimally profitable so that credit unions have incentive to actually do them. At this point right now, there are a number of credit unions out there that are offering short-term small dollar credit, as a member service. If NCUA really wants that to be a much higher percentage, they need to provide, more incentives for credit unions to participate in these types of programs. So the RBC proposal, we're still just a couple months away from RBC going into effect. There is a 2-year delay that is being considered by Congress as part of some various funding bills and as a standalone bill. But NCUA really kind of saw this as it's uncertain whether or not Congress is going to take that step, and there's a clear need for credit unions to have some sort of relief from these requirements, at least in a temporary period. So they proposed a couple things. A 1-year delay of the risk-based capital rule, in addition to an increase in the asset threshold that would exempt more credit unions from some of the harsher requirements of RBC. Again, this is something where Metzger and McWaters kind of cheered their ability to compromise and come to a agreeable solution. However, we at CUNA still think that the 2-year delay is necessary because it would provide NCUA with enough time to actually revise their rulemaking. A year is not enough, especially if you consider that we're going to have a new NCUA board member, maybe two, in the very near future. And they're going to have less than a year to come up to speed on the RBC rulemaking and then kind of evaluate on how it could change and then vote on issue a proposed rule and then a final rule and so on. You need 2 years for that process to play out, not one, which is why we still support the legislative solution going forward. But NCUA seems like they're going to finalize this most likely this month or next month during their NCUA board meeting, and that's a good thing for the industry. But we definitely they need to do more in this space. This is just a list of a few of the other kind of final rules that NCUA has come out with and a few of their pending rules that they have on their plate. Alternative capital, they've been looking at for some time. Alternative capital includes both secondary and supplemental capital and changes to those programs. The federal credit union bylaws are one of the other kind of big initiatives that NCUA is undergoing right now. In addition to just last month, they had 2 rules related to real estate appraisals and then loans to members and lines of credit to members. Some of those rules have been kind of just a cleanup of their regulations, literally moving stuff around to make it easier for credit unions to kind of figure out what the requirements are. But all of these are fairly non-controversial, and so we're likely going to have proposals or final rules on them in the near future, probably over 2019. Any questions on NCUA? All right. So finally, we'll just do kind of a quick grab bag of a few other kind of major regulators in the credit union space. Talk a little bit about the FCC and the TCPA. This is an issue that still is a litigation risk for a lot of credit unions. We've seen a few lawsuits based off of alleged violations of the TCPA. For a while, the FCC basically was kind of throwing up their hands that they couldn't really do anything about this because there was outstanding litigation. That has since been resolved. The court invalidated the FCC's definition of an auto dialer as overly broad, which is a good thing. That's a positive thing. But it sends the FCC back to the drawing board on coming out with a substantial order defining what an auto dialer is. CUNA was a participant in that litigation, filing a joint amicus brief with ABA and ICBA. Most recently, in September of last year, CUNA filed its own petition to the FCC. So the FCC works a little bit differently than other federal regulators. They have a petition process where pretty much anyone, but it's larger entities, file petitions for the FCC to essentially adopt a type of rulemaking or a type of interpretation of their rules. We filed one that was going to be beneficial to credit unions. The FCC sought comment on that, and we expect them to kind of have a reply at some point in the near future. That said, these processes are long. I know that Chairman Pai has the TCPA as a top priority for 2019. 2018 for the FCC was mostly focused on net neutrality, which was a heavy lift for the commission. But 2018 is probably going to be a year that we see some substantive items come out of the FCC related to TCPA. There was recently a circuit decision in the Ninth Circuit, so the Western United States essentially, that vastly expanded the definition of an auto dialer. That's particularly concerning, but we're monitoring that situation to make sure that it doesn't get adopted, that rationale doesn't get adopted by other courts, and hopefully the FCC will come out with a substantive rulemaking or guidance on the auto dialer issue, before the Ninth Circuit's kind of decision spreads across the country. We're monitoring that heavily, and there is potential for, if there is a circuit split at some point where various circuit courts are ruling differently on the definition of an auto dialer, it could reach the Supreme Court. Again, you kind of go into what the Supreme Court is going to look like. At the moment, it's 4-4. There's potential to be another nominee to tip the court in the direction of a more conservative-leaning court, but that's requires a crystal ball to figure out how that's going to play out. ADA website accessibility litigation. I cover that for CUNA, and over the last few months, we've actually seen a slowdown in the number of cases and demand letters related to the ADA. I think a lot of that is probably as a result of some of our legislative victories in the Fourth Circuit, a lot of Virginia cases. We've also seen positive results in Texas, as well as Illinois, and a few other states. But there have been a few adverse decisions on the ADA front, basically saying that the individual, they could be thousands of miles away, not eligible for that credit union's full membership, but some courts have found that they still had standing in those cases and they could progress forward. We are part of some appellate reviews of those types of decisions in the Seventh Circuit and the Sixth Circuit. And then another case in the Fourth Circuit. So hopefully that provides a little bit more clarity on how courts are going to take this issue going forward. But really, this is going to continue to be a problem until DOJ comes out with some sort of substantial standard of what is required of credit unions and other businesses when it comes to website accessibility under the Americans with Disabilities Act. We've met with the DOJ several times, and we're also looking at partnering with other types of entities, other financial trades, other business trades, and so on, to try to use our collective momentum to push the DOJ to come out with, clear rules of the road on this issue. Again, the problem with that, though, is that, the rulemaking process is long. It takes several years. And so it remains to be seen whether or not we're going to have certainty on the regulatory side while these litigation cases continue. But it's an issue that we're very aggressive on. We actually just filed another amicus just a few weeks ago in support of a credit union where there was some kind of novel arguments of law being made by the individual plaintiff attorney. So we're monitoring this issue, and it's really a top priority. I can't even calculate it out. I spend probably about a fourth of my time at CUNA on a day-to-day basis on this issue. And so it's a very much a priority for us and our leadership. IRS, we had a major tax reform bill. Just a few of the most substantial provisions. Credit union tax exemption was preserved, which is a positive thing. There were a number of different industries and tax exemptions that got steamrolled during that process. And so that was really a victory as a result of the entire credit union movement as a collective. Everyone was involved in that. And so that was positive. Making your case to members of Congress, fighting against banker myths was, I think something that we all should be very proud of, that we were able to come out of that relatively unscathed. There still were a few things that impact credit unions, specifically a 21% excise tax on compensation for certain executives paid over $1 million. And NCUA, IRS is still considering coming out with rulemakings that were going to clarify what they mean by that area, whether or not they were going to grandfather in certain types of retirement programs or anything like that. That remains to be seen when that's going to be a priority. I know that the IRS requested a few $100 million in order to allow them to effectively implement the tax relief bill, and it's a very large lift for them. And the IRS has traditionally been a underfunded and understaffed agency, so progress there is going to be slow. But we've made sure that it's on their plate to clarify. And finally, I just want to let you guys know that here's my contact information. I highly recommend that if you have an issue that's specific to your credit union, that's something that we can address on the regulatory front or the legislative front, please reach out to me. I'm more effective at my job advocating at the BCFP or NCUA or any other regulator when I'm able to take a story that I've heard from a credit union, and I make it anonymous, don't worry, I don't say anyone's name, and I say, this is affecting a program, this is providing members less service, this is having a substantial impact. That sort of thing is a lot more powerful when I can do that. And so I encourage you to use me as a resource, and I'm definitely going to ask you lots of questions about what's happening in your institutions too. But thank you very much for letting me speak to you.